On to banks here. The KBW Bank ETF is up almost 34% in 2024, on pace for its best year since 2011. Our next guest thinks M&A could be a big driver for the group in the new year. Let's bring in Chris Marinac of Janney, Montgomery Scott. He's the firm's director of research. Chris, always great to see you. So you are a believer that less regulation, a lighter touch, that's going to allow a lot of bank M&A. What kinds of banks are going to join?
I think the banks less than $100 billion, Melissa, are much more likely to merge. I think the big mega bank deals are going to be hard to do. We may eventually have that happen in the new administration in another year or two. But I think below the $100 billion line of demarcation, there should be a fair amount of activity. And I think what we've seen the last 2 months actually is a pretty good precursor of that deal activity.
The last 2 or 3 months in terms of which deals?
In terms of deals announced in late October through mid-December, there's been a fair amount in the small and mid-sized banks.
So when you take a look at the landscape, how are you thinking about how the deals will be pieced together? Will it be geographically? Will it be kinds of lines of business? The banks that have a troubled real estate portfolio? All of the above, maybe?
I would say it goes back to deposits. Deposits are the lifeblood of the industry. You have great organizations around the country who have excellent deposits that could get you into the Southeast, into the Southwest, perhaps in California. There are very good places where banks can take that funding and lend it out to a greater rate and make a bigger spread the next 5 years. At the same time, you're also taking out costs, and that cost takeout is very meaningful to earnings in the long run.
Hey, Chris, this is Courtney here. So when it comes to banks, we do get a lot of questions from clients where they're saying, how much really should I be concerned about rate pressure and the fact that rates may not be coming down as fast as one had originally hoped? And is that something we should be concerned about with the banks? Or is the fact that the yield curve normalizing better for the banks and maybe this shouldn't be as much of a concern? Like, what would your take on that be?
So I think, first off, the 100 basis point Fed cut since September has been huge for deposit and funding costs. You're going to see that in better margins in Q4 and Q1. I think the yield curve turning positive the last 3 weeks is a big plus. It's going to improve investor confidence. It's going to bring more money back to the sector. I think overall, the Fed slowing down the easing is probably bullish because it allows banks to reset loan yields at a slower pace while their cost of funds has come down much faster. That's where the margin expansion is really happening.
So, Chris, I just had a quick question on the HTM books. I mean, obviously, as the long end of the curve has sort of stayed a little bit elevated here, then obviously if banks are looking to merge, then that's going to be a meaningful concern, something that they probably look at more meaningfully than sometimes investors even do.
Well, you're correct. And in fact, this quarter, as we finish on Tuesday, we should see the marks go right back to where they were at the end of June. We're sort of doing a complete reversal of the positive marks in September. But at the end of the day, the banks are seeing pretty good payoff of the HTM portfolio. A lot of those are in residential mortgage backs that are paying off about 10 to 14% per year. So those are coming off slowly but surely. A lot of the high issues on marks that were hurting banks from the 2020-21 purchases have started to come down and are active. So the marks are important on the deals for sure, but I don't think they're going to threaten the transactions like they would have 18 months ago.
Wells Fargo potentially could have its asset cap lifted as soon as the first half of next year, Chris. That's been reported in Wells Fargo. We've seen the stock respond to those reports. And I'm wondering if that clears the way, in your view, for some acquisitions, even if it's smaller acquisitions just to bolster the deposits or other lines of business.
So I would see Wells doing other lines of business before they jumped into banking. They've got a great deposit franchise around the country, really low cost of funds. I see them adding other business lines before they went back to banking. But if you think about the next 3 or 4 years, could Wells do a bank acquisition? Sure, they absolutely could. I'm just not sure it's going to be a 25 event.